All right, it's great to see everybody. You should be able to hear. Sound should be fine, and you should be able to see the screen. If so, let's get started. All right, so we are going to spend a little time. These sessions are meant to be quick. Again, great to see everybody. It's been a little while. So, there's so much, I developed a supply demand strategy many years ago in the mid 90s, late 90s on the trading floor of the Chicago Mercantile Exchange. And that's when, late 90s when screen trading came about and all that. And anyway, long story short, now 20 something years later, there are many people talking about supply and demand and lots of supply demand stuff out there. In the beginning, there was one strategy. And the point is, a lot of people get confused. There's a lot of people talking about supply demand that have never traded it. A lot of people that, teach it that don't understand it. So we thought we would put together a series of sessions that focus on supply demand zones that work, why they work, why they don't work, what's a real supply demand zone versus one that's not, what's a qualified demand supply or demand zone versus one that's not. So that's what these sessions are for. They're meant to be rather quick. We're going to go over during each of these sessions, we will go over very recent opportunities out of our live sessions at the Pinndx Institute. I deliver sessions every morning for our members. And then we'll follow up. We'll end it with a quick little mini lesson. And these are meant to be powerful, impactful, 10-minute or so sessions to really help get people on the right path. If you have any questions, comments, you can always put it in the chat. Let's begin. So in the morning sessions, we always start with a thought of the day. We thought we'd start with those here as well. And this is a big one, right? Life gets so busy. We get so sidetracked from things. Ask yourself what's important, then have the courage to build your life around the answer and just say no to everything else. It's our life story, and the pen is always in our hands. How true is that? It's funny because there's all these, books and stuff on how to do this and how to do that, all the steps to do this and all the steps to do that, right? Whether it's, losing weight, quitting smoking, getting in better shape, I don't know, just and on and on and on, how to develop a skill. And it's always the things to do. It's always the steps to take. What so many people don't focus on is the word no, right? We all know what to do. I mean, don't most of us know what to do? And, when it comes to most things, what we have a hard time doing is saying no. So when it comes to trading and investing, it's so important to understand exactly how and why how the markets work, exactly how and why prices turn and move in markets, and the rules around that, and then being able to say no to all the distractions, right? Then being able to say no to all the distractions. So this thought of the day, we can, it impacts, it's a part of everyday life and certainly the trading and investing markets. Let's move on. Make sure you understand the Pinndx Institute is not an investment advisor. I am a licensed fund manager in addition to what I do here, but the Pinndx Institute is not an investment advisor. And make sure you understand there is no guarantee of success when it comes to trading and investing. When you risk your hard-earned money in the markets, make sure you understand that available research strongly suggests that the most active traders lose money. I've done YouTube videos on this very topic, a number of them even this year, the fact that most active traders lose money. So no one's pushing anyone to get involved in this. Just make sure before you risk your hard-earned money in the markets, whatever asset class you're trading, make sure you understand what you're doing. And most of all, make sure you understand the risk and you're okay with the risk. All right, let's take a look in just a moment at some trading opportunities from the last few days here. As I said, for those that don't know who I am, I developed the supply and demand strategy, the original supply demand strategy years ago when I was on the trading floor of the Chicago Mercantile Exchange. And what it does is it helps quantify, by following the rules, we can quantify the market's real supply and demand in any market, any asset class. And what that does, by following the rules, it allows to identify imbalances, supply and demand imbalances, which is where prices are most likely to turn, right? So we use it to forecast market price turns and market price moves. Let's take a look at this first one. This is, everything we're going to look at is from the last few days. This one is from, about 2 weeks ago. And what I want to point out here is so by the way, what you're looking at is the chart on the left. These are all screenshots out of our live trading and analysis session. So I was delivering this one with our members. And you could see here, after we had turned from an outside the range supply zone, we simply had an inside the range supply zone here against an inside the range demand zone here. These are not high probability zones because of their location. But nevertheless, because there wasn't much news or anything going on, in other words, because there wasn't anything significant to disrupt the current supply and demand relationship, the supply zone, did what it did, right? Worked out fine here. That's this rally into this. And then prices came down to the inside the range demand zone and then rallied up to the new supply zone and then begin to fall down to here. But the point here is, okay, is that when you look at these demand zones right here, a lot of people would look at these and say, wow, those are great demand zones. 2 fresh demand zones on top of each other, rally-based rallies. The truth is, these are not high probability demand zones. I mean, it worked out fine, right? But when price came back to this level, there wasn't any big negative news that could have brought in a significant amount of sellers. Because if there was, this type of zone with its location, there's not likely to be enough demand in here to cause prices to turn. So not all supply demand zones are created equal. We follow our structure and location rules. Anyway, from this area, market prices moved lower. And then just the other day, we rallied, the NASDAQ here, rallied right into one of our qualified supply zones, okay? When I say qualified supply zone or demand zone, right, there's a drop-based drop, right? And there's a rally-based rally. The reality is the majority of drop-based drops and rally-based rallies are not going to cause price to turn. They're not going to work because they're not qualified supply and demand zones. So many people out there around the world think a supply demand zone is a rally-based rally or a drop-based drop. That's a small part of it, okay? It's all about proper structure and location analysis. I want you to look down here because at this point, current fair value was down here, which is where the majority of buyers and sellers agree to buy and sell, okay? The fact that our qualified supply zone was so far above fair value, that suggested that this was a high probability turning point because fair value is the true magnet for price, okay? Fair value shifts, and again, we apply our rule-based structure location analysis. Price ended up rallying up to the qualified supply zone here. What happens then is the governing dynamics do their thing, right? Competition to sell at supply caused price to turn, right? And pushed it lower. Fair value, which is the true magnet for price, pulled price back down to it. Does that make sense? Right? Now we're talking about the NASDAQ here, but we could be talking about any market. We could be talking about any financial market or the market for anything out there. It's no coincidence also that price just touched the supply demand zone and fell because of its location, right, to fair value. This was a higher probability turning point. This was just the other day. This was the last big drop in the markets last week, okay, into this week, last week and this week. Most of this drop is right here. This part of the drop is this week. This part of the drop is last week, all from a supply zone from our sessions. Now, yesterday, did anybody buy the market down at demand yesterday? Yesterday, the S&P, along with 7 other markets and 9 other stocks in our session, came down to qualified demand zones. This one right here, this is it's basically the 422 and change demand zone in the S&P. That was an outside the range demand zone. And everybody can hear okay, right? Just want to make sure sound is okay. Should be. Right? But anyway, price came down to our qualified demand zone and barely touched it. It actually got down to the 422 something. I forgot exactly what price it was. But we had a pretty sharp turn. And then today, price got all the way up to 430. We took this trade, by the way, full disclosure. We'll always let you know on that. But here, the important thing to note is the profit zone. Notice the distance from demand to supply. The greater the profit zone, right, the higher the probability of the trading opportunity. All right, and this happened to be an outside the range demand zone. And prices came down there. And again, competition to buy, a lot of competition to buy down here, caused prices to turn higher. And that was yesterday. Nice job there in the chat. I see you caught that. Okay, good job. Now, when it comes to supply and demand and our rule-based strategy, it doesn't matter what market we're looking at, and it doesn't matter what financial purpose. Could be day trading, could be swing trading, could be longer-term investing. Okay. But here it's gold, right? But it doesn't matter. Now, what do you notice different about this gold supply zone? Notice price went a little bit deeper into our qualified supply zone here. Well, part of that, right, there's 2 reasons for that. It worked out fine, right? Big 50-point drop in gold futures from our supply zone this week. But notice the profit zone, the initial profit zone at least, was not that big. And most importantly, notice the location of the supply zone here. It's inside fair value. So that's never going to be high probability. It's still qualified based on our rules. And price came up there and ended up turning lower and falling 50 points through the profit zone and through fair value. This was just the last 2-3 trading days here. Okay. And then just a bigger picture. I wanted to show you kind of a bigger swing trading, maybe longer term swing trading example here. When we look at Meta, right, the stock, I wanted to show you an outside the range supply zone. And if you don't know what all this language means, don't worry about it. We're going to do these sessions quite a bit, right? We came into an outside the range supply zone in Meta against an inside the range demand zone. However, there was 50 points of room in between these 2 areas, right? As long as the risk reward meets the minimum criteria we're looking for, we can take the trade like a robot. Ultimately, supply demand does its thing, right? Reaches the outside the range supply zone, strong competition to sell up there causes it to turn, pushes it lower, right down through fair value, all the way down to the demand zone, where again, competition to buy down here causes price to turn and pushes it right back to the middle. Another way to say all this is simply retail prices, supply, wholesale prices, demand. Make sense? And it's all about structure, location, analysis. So these are trading opportunities we took we went over in our sessions, our live sessions. I want to leave you with a mini lesson, okay? And we'll do these mini lessons. We'll do these mini lessons every single time we have a session, and I think we're going to have a lot of these sessions. So these are meant to be short, impactful, to the point. Indicators and oscillators, moving averages, stochastics, Bollinger Bands, RSI, CCI, MACD, and so many more. This list goes on forever, right? They don't work with supply and demand. Why? Why don't we use any of these with supply and demand? I'll show you. Israel Hernandez, thanks for the kind words there. I see what you're saying in the chat there. And while I appreciate that, the reality is I look at myself as the messenger. Nobody created supply and demand, right? Even Adam Smith didn't create supply and demand. It's been here forever. The point is, this is how the markets really work. This is how I saw them working when I was on the trading floor before looking at price charts with buy orders and sell orders in front of me. I simply figured out what that looks like on a price chart. And it's just supply, demand, fair value, like anything out there. Yes, Brandon, you got it. Here's why we never combine indicators and oscillators with the original supply demand strategy. Take a look. Okay, so here we have supply demand on the left, supply demand fair value, right? Now, notice price is coming down into a demand zone here on the chart, right? This is where our rules would have us buying if we're okay with the risk and reward. But a lot of people use an indicator or an oscillator, something like that. In this case, moving averages to enter positions. A lot of people wait for a moving average crossover before they buy right here, where the moving averages cross. Now, if you wait for the moving averages to cross, that means you're buying all the way up here, okay? The problem is any of these indicators and oscillators, right, they all lag price, which means, okay, they only do what price has already done, right? They all lag price by a certain amount. So if you think about it, adding any tool to your decision-making process, specifically to your buy and sell decision-making process, you're only increasing risk, in this case, probably tripling your risk, right? At least triple, and you're decreasing your reward. Why would we ever want to do that? Okay. Indicator-based entries mean you're buying after a rally in price and selling after a decline in price. That's high risk and low reward. Okay. Typically, if you're using an indicator or an oscillator, it's because you're kind of using it as a crutch. And that typically means you probably, if we're being real, you probably have a supply-demand weakness that can be worked on and fixed. Does that make sense? Okay. We don't want to add anything to the concept of buying at wholesale prices and selling retail prices that lags price. And I'll leave you with this. Would you ever walk in, let's say you went to the food market, the grocery store, because you love ice cream. Maybe you love chocolate ice cream. It's your favorite thing to eat, and you always have to have it. Have you ever walked in the store, you go get your chocolate ice cream, and then you go to pay at the checkout counter? And the ice cream, let's say, is, I don't know, maybe it's $5 for your container of ice cream. It's your chocolate ice cream. Do you ever walk up to the counter and say, look, I know this is $5, but I love the chocolate ice cream so much, I want to pay you $10 for it. Has anyone ever done that? No, we would never do that, right? So why would you do it here? It doesn't make any sense. Trade what is real, not what you feel, right? How you make money buying and selling anything in life is how we make money buying and selling in the financial markets. Okay? I'll leave you with a few thoughts. The movement of price in any and all markets is simply a function of an ongoing supply and demand relationship. Price turns at levels where this simple and straightforward equation is out of balance. Risk mitigation and return on investment opportunity is present, again, when this simple and straightforward relationship is out of balance. Right? So hopefully that was helpful. And I'll read back in the chat here for a minute, and then we're going to have a lot more of these sessions coming up. Thanks a lot for the kind words in the chat. Very, very much appreciated, and humbled to be, always good to get together and go over this stuff. So good question on the time frames there, Adrian. The reality is, yes, we have a separate set of time frames for day trading, a separate set of time frames for swing trading, and another one for longer term investing. Two things to that, though. The strategy rules, right? The original supply demand strategy rules don't change. amongst any of those time frames. And two, there is no perfect time frame. We're looking at multiple time frames to find the evidence that we're looking for that shows us where the supply-demand imbalance is. Okay. And Joanne, yes, you're often not going to see your supply-demand zones and fair value on the same time frame, and that's okay. We have a very rule-based way that we do that. Okay. Yeah, and anything we're talking about here, make sure you understand we would apply equally to stocks, futures, Forex, options. It doesn't matter. On that note, it was great to be with everyone. Good to see you again. And I know we have another one of these sessions coming up. I think these are going to be quite a bit, actually. A lot of these, and we will see you at the next one. Have a great day, everybody.